All right, everyone, it is August, and I want to share with you today the 3 dividend stocks that I am personally purchasing in August. Now, I am shifting my strategy a little bit from last month in July. In August, I'm going to be buying 3 stocks that are a little bit different from my selections in July. And the reason I like to vary it up is just to keep things interesting, to keep myself focused, and to stay in the game. Now, the 3 stocks I am purchasing in August are also like the ones in July on my ride or die stock list. These are my favorite dividend stocks of all time. So the 3 go like this: PepsiCo, Johnson & Johnson, and Kimberly-Clark. And so I'm going to dig into those 3 stocks today. But before I even do that, I also want to cover Apple, which is another stock that I own, because I'm getting a lot of questions about Apple right now on my Facebook community, here on YouTube, and a lot of investors right now are buying more shares of Apple. So I want to share my experience with Apple and why I am not buying more shares now, but I do wish everyone buying more shares all of the best. So it's going to be an exciting video today. I apologize in advance. I'm kind of a mess right now. I just got home from a long day on the construction site, so it's been a really busy day for me. I work in commercial real estate, hot 90-degree weather out on the construction site, so I'm just transitioning right here into the video because I was on vacation last week, and I know a lot of you have been waiting for this video for a while, so thank you for being patient as well. And for those of you who know, I love rap music, and I wanted to quote one of my favorite rappers of all time, Nas. He has a track that is called Nas is Like, and on that track, what Nas says is he lets his cash invest in stock. That's what I'm doing right now in August of 2020, so get ready, everyone. Exciting dividend investing video today. All right, everyone. So I want to jump right into it with Apple. Check out on the screen right now my purchase history with Apple, and you'll see that I started purchasing Apple stock back in 2018. In December of 2018, I bought 2 tranches, and I'm only portraying the net new tranches I purchased here. I'm also reinvesting dividends. I'm not showing that on the screen. Just want to keep it simple. And you'll see that I bought at 171, and then it tanked 12% in just 13 days to 151. What did I do? Did I head for the hills? Did I get concerned that I bought shares? Did I regret what I did? No, I took the opportunity to buy more shares. I averaged down. And this is one of the first key takeaways from the video today, is that oftentimes investors get skeptical, they get scared, they get frustrated when a stock that they buy goes down. But for me, if I buy a stock and it goes down and I still have a conviction in the stock, which I usually do because I do a lot of research up front, I usually take the opportunity to buy more shares. I don't get scared. I don't head for the hills. I don't regret anything. In fact, I look at it as an opportunity, just as I did with Apple. Anyways, fast forward to today, and I'll share on the screen. You can see that the current price per share is $438. So I'm up 156% on the first tranche, 190% on the second tranche. And this is in just 20 months' time, so less than 2 years' time. And so another key takeaway is that with dividend investing, dividend growth investing in a dividend growth stock like Apple, it is possible to achieve great dividend cash flow. Although in the short run with Apple, it's kind of low, but it will grow over time. But more importantly, capital appreciation. I know a lot of investors out there, look, I'm not really in the game for capital appreciation, but I know many, if not most investors are. And there's this belief that with dividend investing, dividend stocks, this opportunity for capital appreciation, it's not there anymore, and that is just not the truth. Apple is a dividend stock, and Apple has provided great capital appreciation for dividend investors. And so I want to share on the screen right now some stats that Apple has right now. What does the stock look like? What are some of the stats that I like to look at? And so it's currently trading at $438.66. The 2020 EPS estimate is $12.94. 2021 is at $15.50. The PE forward basis for this year is a 33.90. Next year is at a 28.30. And so one of the first things I want to point out is that it is trading at a full fair valuation, if not overvalued. It is at PE level in the 30s right now. And yes, they had a blockbuster earnings report. Yes, they announced a stock split. Yes, things are going very well for this company despite the horrible global pandemic that we're in right now and the horrible economic shutdown that we're facing right now. And they continue to thrive in this environment. So it is being bid up to really high levels and trading at a premium because of their strong performance. But the reason I'm highlighting the PE ratios here is personally, I am not buying Apple at these levels other than reinvesting dividends because I think it is probably a bit overvalued here. And I'll share something else right now. A lot of people are thinking, wow, there's a stock split. Should I buy more? Personally speaking, stock splits are absolutely irrelevant to me and to the value of the company. What Apple is deciding to do, because the stock is trading now in the $400 range, is instead of having shares in the $400 range, they want their shares in the $100 range. So they're doing a 4-for-1 stock split. But as an investor, you or me, yes, sometimes when a stock split is announced, the stock will go up a little bit because there's more interest. But other than that, and also a company, they will only announce a stock split if they have confidence in the company. So obviously Apple has confidence. So those things are good. But the actual action of the split, it doesn't create any net new value. Instead of having one share in the $400 range, is now for each one share, I'll have 4 shares in the 100 and change range. And so no net new value is created. And then the dividend will be cut by divided by 4. And so there's no net new dividend value either. And so stock split, non-event to me. And so people are wondering, Ian, are you buying here? Oh my gosh, they announced a split. Are you going to buy more? No, I am reinvesting dividends, but absolutely the stock split is a non-event to me, and the price that it's trading at now to me seems a bit overvalued, but I love it. I'm proud of it. It adds value to the portfolio, and I'm thankful to have this growth engine in the portfolio. So I want to share some more statistics. Check it out on the screen right now. And what you can see is the dividend per year is 328. It is trading at a dividend yield now of less than 1%, 0.75%. So I highlight that it is a very low dividend yield. Anyone looking to pay bills from Apple stock anytime soon, it's just not going to happen. Even for me, if you look at my yield on cost, not counting reinvested dividends, just simple yield on cost, my first tranche is a 1.91, my second tranche 2.17. Even having bought this before the run-up, my yield on cost is still a bit low, although I do think in about 10 years or so, my yield on cost will start looking more meaningful, which brings me to the next statistic, which is that dividend compound annual growth rate. For the last 5 years, on average, they've raised the dividend 9.5% per year on average. And so that's a really good thing, and I highlight it for that reason. And the payout ratio is low at 25%, which gives them a lot of room to increase the dividend. Now, one thing at the end here that I also highlight is the market cap. The aggregate value of all of the Apple stock now is $1.88 trillion. And I highlight this for a reason because I'm going to share 3 stocks next that I am buying right now. And what you'll see is when you add up the value of each of these 3 stocks, even combining the 3, it's worth a lot less than Apple. And you start thinking, when even companies like Johnson & Johnson that are responsible for the global well-being and healthcare for global society is trading at a fraction of what Apple is worth, you start thinking, is the market mispricing something here? Is the market maybe overlooking the value that is in Johnson & Johnson, or maybe overvaluing Apple, or a bit of both? And so I highlight the market cap here because it's astronomically high. Yes, it could go higher. I'm never going to sell this thing. I'm reinvesting dividends. But that being said, it provides a context for the 3 stocks that we're going to look at next. And so before I do that, though, I want to share really quickly just some news with Apple. So check it out. What's happened now is they announced the fiscal third quarter earnings. Revenue is up 11% year over year, earnings 18%. I loved that international was 60% of revenue because I'm a global investor. I'd love to see that. Put in the comments below if you are where you're from, just put it. I'd love to see. I know I've asked this question before, but I love asking it again because my favorite part of this community is that it is not just, people from my hometown in the Bay Area, although I love you all, everyone from the Bay Area, and I wish we could do our meetups. I can't wait till we can do our meetups again. Once it makes sense, given all of this social distancing that we're under right now. But I love the global nature of this community, so please share in the comments below. And by the way, while you're at it, don't forget to give that big thumbs up, a like to the video today, especially if you're a fan of Nas like I am as well, or rap music in general. Thank you all for the support. And so with all of this news, they're doing a 4-for-1 stock split, which is a non-event in my opinion. Now check this out. So this is important. I want to share on the screen right now the assets and the liabilities for Apple from their balance sheet, because I'll tell you, in the past, people were saying, Ian, and I believed this too, and it was this case when I was first looking at Apple back in 2018, and even before then when I was studying it. And fun side note, I used to own Apple before 2018, but I did sell it to deploy those funds into another investment, but I bought back, so my stake that I own now was purchased in late 2018. But anyways, back in the day when I was an earlier investor in Apple, what the case was that they had a lot of cash. And because they had so much cash, the share prices were really high and the PE was a bit high, but if you took out the cash, the PE was more at a normal level. And so investors might be thinking, Ian, PE is not really in the 30s, they got all this cash. But I'll tell you, it really is in the 30s because the cash is not like it was before. So check it out on the screen right now. Check out the assets. Let's look at that. And so I'm pulling up the assets from their latest quarterly report. And what you can see here is, what do they got? 33 billion cash, 59 billion marketable securities. That's in current assets. And then in long-term assets, non-current, they have another 100 billion of securities. They got some good property, plant, and equipment, other non-current assets. I'll just take it all. Let's just say all of this is cash or cash-like, even though it's not. There's other line items here on here for inventories, for example, and receivables, for example. But let's just assume this is all reasonably current or somewhat liquid cash or cash-like securities. It's pretty good. They got $317 billion. And on its own right, that would be a reason. Let's say they had no liabilities. That would be a reasonable chunk out of their total market cap. And it would lower the PE if that were just all cash and they had no liabilities. But the fact of the matter is they do have liabilities. So check it out on the screen right now. And I want to move into the liabilities. And what they have basically are accounts payable, other current liabilities, 35 billion in each of those categories. 95 billion in current liabilities, and you go into long-term non-current, they've got 94 billion in debt, another 55 billion other non-current. Basically, total liabilities are 245 billion. And so again, if assets are 317 billion, liabilities are 245, they basically net each other out. And so yeah, they got some shareholders' equity there, and they've got a great balance sheet, a great cash position. But what I'm trying to say is it's not like the Apple of a few years ago. The Apple of a few years ago, the cash was pretty big as compared to liabilities, and it was a factor that you wanted to take out when looking at PE ratio, because it was kind of pushing up PE. But that is not the case at this time, in my humble opinion. At this time, the PE is the real PE. There's no kind of inflation due to huge cash position. And in my personal opinion, and so I do think Apple is overvalued. And so I just wanted to do Apple first because I'm getting a lot of questions about it. People are asking me about it. Now you know. I'm going really quick today because I am tired. It has been a long day. So hopefully I'm not speaking too quickly. Thank you for hanging in there. And by the way, huge thank you to my patrons, those supporting me on Patreon financially. It means the world to me. You can now support me on Patreon for as little as $3 a month, and it makes a meaningful impact on my ability to produce videos on a timely basis. And it's been tough keeping up lately, especially coming back from the vacation. Check it out. I'll share a photo from the vacation. Here's me drinking some Starbucks on vacation. It was a really fun. By the way, I bought more Starbucks on Monday. Heading into to this month, though, or at least for the remainder of this month in August, I'll probably be taking it a little easier on my Starbucks purchases because I do want to save capital for PepsiCo, Johnson & Johnson, and Kimberly-Clark. And so with that, check it out on the screen right now. I want to share PepsiCo. And so Pepsi, it's not a deep value. The PE right now on a forward basis is a 25 for 2020. It's a 23 for 2021. Certainly it's a better PE than Apple, but it does not have the growth characteristics that Apple has, and so it should not warrant a PE as high as Apple's. And quite frankly, if you kind of look at PepsiCo as a company that is not really growing right now because of the global pandemic, and Apple is a company that is, I would almost say adjusting for risk and adjusting for growth, I don't really think Pepsi is a value, that much more of a value than Apple would be. And so I just want to be honest with myself and with you. I'm sharing Apple off the bat. I'm saying I'm not buying more, but then I'm sharing Pepsi. I'm saying that I'm buying more. I'm buying more because it's my number 2 favorite stock of all time. I haven't been buying enough shares in recent years. I need to build my position. I think it has a reasonable starting yield, and that's why on the screen right now, what you'll see is I highlight the starting yield. It's almost 3%. It's at 2.98%. But on kind of a growth-adjusted forward PE ratio, if you look at Pepsi's in that 25 range, Apple in those 30s, and you adjust for growth, quite frankly, they're probably valued pretty similarly. And so what I'm just saying again is Pepsi, it's not a bargain right now, but in the scheme of things, it is a very stable company. I think they are in a less risky business than Apple. Apple has a lot of concentration on the iPhone. They have a lot of concentration on certain products. It's a tech company that is open to disruption. It is trading at a huge market cap, whereas Pepsi, their market cap is 191 billion. They provide food, beverages, snacks that we all need to live. It is in a relatively more safe industry. And so that's something that needs to be factored in there as well. And quite frankly, it's my number 2 favorite stock. I need to add more because I just haven't been doing it in recent years. But you'll see in a minute, don't worry, that J&J and Kimberly-Clark, in my opinion, are values. Pepsi, not necessarily value, but I'm buying it for the reasons just mentioned. And so the dividend has grown 7.8% on average for the last 5 years, although the payout ratio now is 76%. So I don't know if that clip of dividend growth will keep up. Now I want to share some notes on the screen from the Q2 earnings from Pepsi. Organic revenue was down 0.3% in Q2. Organic revenue takes out currency fluctuations. It also takes out businesses that might have been acquired or sold off. So it's looking apples to apples. And so their revenue is holding up somewhat, but their EPS, or on an organic core basis, was down 11% in Q2. So the EPS is hurting a little bit during this time of global pandemic. And when I look at their earnings release, what was really happening is the beverage business was facing weakness because people are not in amusement parks, they're not at sporting events, they're not at movie theaters, but their snack business in Frito-Lay and their Quaker Oats division, because people are snacking more at home, are doing extraordinarily well. And so that's nice to see that their balanced approach is paying off. And I really like that they are launching snacks.com and pantryshop.com going direct to consumer. That is really important for me. All of the companies that I own must be embracing technology, or at least trying to embrace technology as much as possible, because otherwise they will get disrupted. So I like to see that at PepsiCo. And so I do want to share on the screen with you right now. I took a screenshot from PepsiCo. Let me pull it up on my computer as well. And this is from their Q2. And again, what you see here is just check out the organic percentage change column. Frito-Lay North America is up 6%, Quaker Oats 23%. But then you see some weaknesses in the beverages North America, in Europe, in Africa, Middle East, South Asia, But Asia Pacific, Australia, New Zealand, China, you have some growth. But again, what you kind of see here is weakness in beverages, strength in snacks, and so good to see with Pepsi. But again, for me, it's more of an allocation play. It's more of a, quite frankly, a little bit of a current yield play, because I do like, for a company of its stature, I do like the starting yield that is nearly 3%. All right, I want to move on really quickly now to Johnson & Johnson. This is another stock I want to buy in August. It's my number one favorite dividend stock of all time, and I think it is a value. So check it out. And what I want to share with Johnson & Johnson is, let's just start with this. Market cap, $387 billion. This is a company that is trading for a fraction of what Apple is trading for. But Apple, and I don't want to discount the value of what they produce, but they are producing phones, basically. And Johnson & Johnson, by contrast, is producing household consumer-related products related to health, pharmaceuticals, and medical devices. Johnson & Johnson is responsible for our collective global health. Shouldn't the company in the middle of the pandemic responsible for global health, obviously I have competitors out there, many of which I own, shouldn't be trading more for that, just on a philosophical level. Sometimes this is just a takeaway. I look at things top down on a philosophical level, and it just looks a little interesting on that level. Anyways, what I want to share right now is the PE ratio on a forward basis is an 18 this year, a 16 next year. Discount territory, given where interest rates are, given where the overall stock market is. I think this is a good value right now. Dividend yield is almost a 3%. It's a 2.74 with that sweet 51% payout ratio. Dividend growth a little slower than I'd like at 6.1%, but not bad. What do I want to do with J&J? So check out some notes on the screen right now. I'm going to share a few screenshots. First one are just some notes on the recent earnings. The non-GAAP sales were down 9%. Non-GAAP EPS were down 35%. I do the non-GAAP because it's kind of like PepsiCo with the adjusted EPS. When it's adjusted, they're adjusting for one-time stuff, making it a little easier to compare year over year. The results for J&J right now are not that good. And so I want to share on the screen with you right now another screenshot. And what you see from the J&J results, if you start looking, they share what's going on by segment. And if you look at just the last column, adjusted operational, consumer health, it's okay. It's down modestly. Pharmaceutical, it's doing well. It's up. But what is well down? Medical devices. And so this doesn't concern me too much. Hospitals right now are probably not making very large investments in medical devices, except devices that are directly related to the pandemic. Quite frankly, from what I've read, some hospitals now are facing some challenges, especially because many people with elective procedures or procedures that can be delayed, they are choosing to delay them out of fear of going through any kind of major procedure right now. And a lot of hospitals are really trying to focus on the pandemic. And so naturally, it makes sense to me that medical devices are down. But this pandemic, in my humble opinion, it will not last forever. Things will come back, and it is just abnormal now. But what is interesting is the analyst estimates that I just shared with you, they generally factor in these results. They factor in these results because the analysts are looking what is going on with the company. And so if it is trading at a PE in the teens right now, despite these lackluster results, if you will, in the current year, I like that because I know going forward, medical devices will come back, growth will come back, PE on cost will be even lower than it looks right now. So that's really exciting. So I want to share another screenshot with you right now. Check it out. And what this one shows is just the results. You can see overall, I like to look at the non-GAAP again, but operational sales are down 9%. And EPS is down 35%. So this is what I just shared on an earlier screen. And so basically this company right now, it is facing some weakness. It is trading at a discount PE. I think the company is undervalued. I believe that the company will sport some earnings growth and revenue growth in years to come, but I think it is being suppressed because of this nasty pandemic. And so I am taking this opportunity to buy, and quite frankly, even adjusting for all of this stuff going on with the earnings right now, it is just trading at a really attractive PE. So I like that. And I have to remind myself, even though J&J is already my largest position, even though J&J, I have a concentration of risk there, I cannot forget to add to it. And that's one of the reasons, like Pepsi, I want to add to it. And that brings me to Kimberly-Clark, which is the third position I want to talk about today. And Kimberly-Clark, so what's interesting is Pepsi, J&J, they're kind of having some weakness in earnings right now, but I'm willing to look past it. And I think J&J it's priced for that weakness. Pepsi, it's a little overvalued, but I'm still buying. Kimberly-Clark is interesting. It's kind of like Apple. Their earnings are surging, and they're surging because the company is flourishing during these hard times. And I'll tell you how they're flourishing, because they are selling toilet paper. They are providing the toilet paper that all of us need at home. And we all know that consumers around the globe are stockpiling toilet paper, and they're doing it for two reasons. One, they're spending more time at home. And when you spend more time at home, you're going to the bathroom at home, whereas you would have gone to the bathroom at work. So you need more toilet paper. But the other reason is psychological. A lot of consumers right now, they just feel more comfortable having a little stockpile of toilet paper. For whatever reason, that toilet paper provides them comfort. And with the Cottonelle and Scott's brands of toilet paper, Kimberly-Clark is flourishing. So with that, let me share on the screen right now. And now, mind you, Kimberly-Clark is trading at an all-time high. This is one of my favorite dividend stocks of all time. I was buying it heavily a few years ago when it was on sale. It's not on sale now from a share price standpoint, but it is from a valuation standpoint, and I will be averaging up. And again, it's kind of like Pepsi and J&J. Another reason I just want to buy more is I've been neglecting it. I haven't been adding to it. And it's such a focus of mine now with all of my top ride or die favorite dividend stocks of all time. I don't want too much time to elapse between purchases. I want to be actively buying them all. And so with that, Kimberly-Clark is at $156 and change now. The 2020 forward PE is a 20. Next year is a 19.86. And so it's fairly priced. I'd say, though, in this market for a world-class company with a lot of growth at this level, I would say it's probably a little undervalued, because with this interest rate environment, with this stock market environment, stocks of this caliber tend to be trading for higher multiples. Now, worth mentioning, I'm always averaging in, but I do believe the market will correct again. I don't think this is just a V-shaped recovery. I think there will be another dip, and when the dip does come, I will go more heavy if it does come. But even if it doesn't come, I'm buying now. I'm always buying. And so I just want to mention that, because stocks are a little more expensive now. I'm not going to kid you or myself. All three of these stocks are, they're reasonably expensive. I guess J&J is probably the best value. Kimberly second best. Apple and Pepsi, they're priced to perfection. But that could all change if we face another dip, which I wouldn't be surprised if we do. Anyways, with Kimberly-Clark, check it out on the screen right now. The starting dividend yield is a 2.74%. Nice payout ratio of 56%. Dividend growth rate is kind of low at 4% per year on average, but they might have more room to grow it. And I love their market cap of only $53 billion, a lot of room to increase that. And so what I want to share next are just some notes. So check it out. And the adjusted EPS that they just announced from their Q2 earnings is up 32% year over year. Let me repeat that. Apple earnings were up 18% year over year. And with that, the stock is just going crazy. Kimberly-Clark earnings were up 32% year over year. So on a Thug Life note, Kimberly-Clark is actually accelerating earnings faster than Apple right now. And this is the toilet paper company. This is the tissue, the Kleenex company. This is the diaper company. It's just amazing. And so some more notes. Organic revenue growth is not quite as strong as Apple's, but they're targeting 4 to 5% for 2020. And I guess there's a risk factor. It's trading right now at an all-time high. And so that is certainly something to keep in mind. And so with that, I want to share on the screen right now some notes from their recent earnings release. And so what you see here, our second quarter adjusted earnings were $2.20, up 32% compared to 2019. And it also says the cash provided by operations was $1.579 billion versus $609 million in the same quarter last year. This company, just check it out, is doing really well right now. But what I would say is, it's one of these companies kind of like Clorox. I guess Clorox is doing really well because of the bleach and the wipes. Kimberly-Clark is doing really well because of the toilet paper. But Clorox, I'm not buying Clorox now. I wish I was, but it's just too expensive. And the thing about Kimberly-Clark, though, it kind of falls in that similar bucket to like Clorox, but it's trading at a reasonable valuation, and I don't know how much longer that's going to be, so I want to buy more. And in fact, my next stock purchase, it's probably going to be Kimberly-Clark. I'll start with that because I could see a scenario where it continues to increase in price over time. So those are the three stocks I am buying right now in August of 2020. Check it. Share in the comments below which are the stocks you're buying right now. I would love to know. The community would love to know. I love you all. If you enjoyed the video today, if you appreciate me working so hard to get this video out after such a long day, I'm just doing my best here. I know this video may not be at the production quality of my others, but I got to do it for all of you out there. Please give me a thumbs up, a like, subscription, comment. All of that means the world to me. Also, I'm looking for support on Patreon. And thank you so much for all of the generous patrons so far. It means a lot. There's a lot of expenses, including my time to running this channel. So thank you, everyone, for supporting, because I put all of my best content forth here on YouTube for free. There's no course. There's no add-on. This is it. I want it for everyone right here. Thug life all day, every day here on YouTube. I love you all. I'm going to let my cash invest in stock just like Nas. Before I go today, in terms of full disclosure, I am long Starbucks, ticker symbol SBUX, Kimberly-Clark, ticker symbol KMB, Johnson & Johnson, ticker symbol JNJ, PepsiCo, ticker symbol PEP, Apple, ticker symbol AAPL, and Clorox, ticker symbol CLX. I own all of those in my personal dividend stock portfolio. Before I leave today, in terms of a disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm literally just sharing my journey here on YouTube for fun and entertainment. Investing in the stock market carries a lot of risk, especially right now, because it could be, who knows, if there's another dip. It may not be a V-shaped recovery. So a lot of risk out there, everyone. I love you all. Please show your love, show your support out there. I'm on all the social media networks as well. I'll see you in the next video.